Hi everybody, today I'm going to talk about revenue recognition principle and the matching principle in accrual accounting. Well, lenders and investors rely heavily on net income to make their lending and investing decisions. So it's very important that they make sure their reported net income is correct. Misstated net income happen when the adjusting entry is recorded in the wrong amount or wrong period. The purpose of the accrued accounting is to help management to avoid misstatement of net income. It comprises into two principles, revenue recognition principle and the matching principle. The revenue recognition principle helps the management to record correct revenues in the correct amount and the proper accounting period. And the matching principle is to help the management to record expenses in the right amount and accounting period. Next, let's talk about the revenue recognition principle. You should recognize revenue when the revenue is realized or earned. For the revenue being realized or earned, a few things need to happen. First, you need to deliver the goods or services. Second, you should receive cash or claims to cash or the assets that can be converted to cash. Third, the earning process needs to be substantially complete or you need to deliver the promised goods or services. There are three situations in revenue recognition principle. The first case is when cash is received at the same time as the revenue is recognized. This one is easy because both cash flow and earning process happen in the same accounting period, so there is no adjusting entry needed. The second case is when cash is received before revenue is recognized. In this case, you will have to defer the revenue recognition until it is earned. So even though you receive the cash in the first year, you cannot record revenue until the next year when you actually earn it. Adjustments will be needed with this deferred revenue at the end of the first year. The third case is when cash is received after the revenue is recognized. In this case, you will have to have what is called accrued revenue because you will record the revenue in the current year, but the cash will be received in the following year, and there will be adjustments needed. Let's go through some examples. In the first case, let's assume XYZ company paid ABC company a 5% sales commission on all the sales it helps to make. In 2017, ABC company received a $100 sales commission on the sales they made in 2017. Well, since ABC company earned the revenue, it recognized the revenue at the same time when it received the cash. So there is no adjusting entry or other account are needed. It's a very simple situation. In the second case, let's assume in 2017, ABC company received $100 cash in advance from XYZ company for sales commissions. In 2018, ABC company earned $100 sales commission. As you can see, in 2017, ABC received the cash in advance and hadn't performed the service yet, so the company has an increased liability called unearned revenue. In the following year, when ABC finally performed the service and earned the revenue, its liability is reduced. The cash is now recorded in 2018 because it was already recorded in 2017. The key point here is that unearned revenue is used to defer revenue recognition until 2018 when the revenue is recognized. In the third case, assume ABC earned $100 sales commission for the sales they made in 2018. but did not receive the payment until 2019. In this case, ABC recorded the revenue because the revenue is earned in 2018. Since the company did not receive the cash, it needs a debit account to balance out the entry, and the debit account is called account receivable. When ABC finally receives the payment, it has to remove the account receivable by crediting it. The key point is that the account receivable is used to accrue revenue until 2019 when the cash is finally received. Next, let's talk about the matching principle. The matching principle should recognize the expenses and their attached revenues in the same accounting period. In other words, you have a revenue. Think about the expenses that help you generate the revenues. You match and record both in the same accounting period. There are three common matching principle situations. The first situation is when cash is paid at the same time as the benefit is received. This is similar to revenue recognition principle. There are no adjusting entry needed. The second case is when cash is paid before the benefit is received. In this case, you will have to defer the expenses until the benefit is received, and adjustments will be needed. In the third case is when cash is paid after the benefit is received. In this case, you will have to accrue the expenses in the first year and increase liability which is finally paid off in the following year. Adjustments will be needed. Let's look at some examples. In situation 1, assume XYZ company made a $2,000 cash sales and paid ABC company a $100 sales commission in 2018. Here you can see the selling expenses are probably matched to the sales revenues in the same year. In compliance with the matching principle, there is no adjusting entry or other accounts needed. It's all self-contained in the same year. In the second situation, assume in 2017, XYZ paid ABC a $100 commission in advance. In this case, since XYZ has not received the benefit yet, the company has prepaid expenses of $100. This is an asset given cash in exchange to another asset, which is the prepaid expenses. In 2018, XYZ made a $2,000 cash sale and incurred a $100 commission to ABC. Since XYZ has paid for it, the company will eliminate the prepaid expenses of $100. As you can see, the selling expenses are probably matched to the sales revenue in the same year, even though the cash flow occurred in 2017. The key point is that the prepaid expenses account is used to defer expenses recognition until 2018 when the expense is recognized. In the third situation, let's assume XYZ made a $2,000 cash sale and incurred a $100 commission to ABC in 2018. XYZ has decided not to pay commission until 2019. Therefore, XYZ has to set up a liability called account payable. The cash is paid in 2019 and thereby the company reduces liability. No selling expenses are recorded in 2019 because it matches the revenue back in 2018, and the account payable is eliminated. In compliance with the matching principle, you can see that the selling expenses are properly matched to the sales revenue. The key point is that account payable is used to accrue expenses into the current period, allowing later payment. Even though there are many other transactions do not affect revenues or expenses, they still must be recorded. For example, if you receive a dollar asset by giving up another dollar asset, the asset will increase and the other asset will decrease, the net income is not affected. If you receive a dollar asset but increase a dollar liability, assets will increase, liability will increase, but net income is not affected. If you receive a dollar asset by issuing a dollar of capital stock, assets will increase and the equity will increase. Net income is not affected. If you pay a dividend by giving up a dollar asset, equity will decrease and asset will decrease, but net income is not affected. I hope this presentation helps you understand more about the revenue recognition principle and the matching principle in accrued accounting. Thank you.